Welcome back to the channel. Our today's topic is the financial system explained in 10 minutes. The modern financial system is one of the most powerful forces shaping the world today. It determines how money moves, how businesses grow, how governments fund projects, and how individuals save, borrow, and invest. Yet for something so important, most people only see small pieces of it. We see bank accounts, credit cards, loans, stock markets. But these are just parts of a much larger system. Behind the scenes, the financial system is a complex network of institutions, rules, and markets that keep the global economy running. To understand how money really works, we need to break this system down into its core components. Because once you understand the financial system, you start to see the world differently. You begin to see how wealth flows, how opportunities are created, and how economic power is distributed. At its most basic level, the financial system exists to solve one fundamental problem. The problem of moving money from where it is not needed right now to where it can be used productively. Think about this for a moment. Some people and organizations have extra money. Others need money to build businesses, buy homes, or fund projects. The financial system connects these two groups. It allows savings to become investments, and investments to become economic growth. Without this system, modern economies would struggle to function. The financial system has three major roles. First, it allows people to store money safely. Second, it allows money to flow through lending and investment. Third, it allows risk to be shared and managed. Let's start with the most familiar part of the system: banks. Banks are the foundation of modern finance. They perform a simple but powerful function. They take deposits from people who want to store money safely, and they lend that money to people or businesses that need it. When you deposit money in a bank, the bank does not simply store it in a vault. Instead, much of that money is lent out. A portion may go to someone buying a house. Another portion may go to a business expanding operations. Another may finance infrastructure projects. This process is called financial intermediation. Banks act as intermediaries between savers and borrowers. In return for lending money, banks charge interest. Part of that interest becomes the bank's profit. Another part may be paid to depositors. This system allows money to circulate throughout the economy rather than sitting idle. But banks are only one part of the financial system. Another major component is financial markets. Financial markets are places where assets are bought and sold. These assets can include stocks, bonds, currencies, commodities, and derivatives. The most famous financial market is the stock market. When a company wants to raise money to expand its business, it can sell shares of ownership to investors. Investors buy these shares with the expectation that the company will grow and become more valuable over time. If the company succeeds, the value of the shares increases. This allows investors to benefit from the company's growth. Stock markets therefore connect businesses that need capital with investors who want opportunities to grow their money. Another major financial market involves bonds. Bonds are essentially loans. When investors buy bonds, they are lending money to governments or companies. In return, the borrower promises to repay the loan with interest. Governments use bonds to fund large projects such as infrastructure, healthcare, and education. Companies use bonds to finance expansion, research, and new technologies. Together, stock markets and bond markets help channel trillions of dollars into productive economic activity. But the financial system goes even deeper. Another important component is central banks. Central banks play a unique role. Unlike commercial banks, their job is not to maximize profit. Instead, their primary responsibility is to maintain stability in the financial system. Central banks control the supply of money in an economy. They also influence interest rates. Interest rates are one of the most powerful tools in economic policy. When central banks lower interest rates, borrowing becomes cheaper. This encourages businesses and consumers to spend and invest. When central banks raise interest rates, borrowing becomes more expensive. This can slow down economic activity and reduce inflation. Central banks also act as lenders of last resort. During financial crises, they may provide emergency funding to banks or financial institutions to prevent the entire system from collapsing. Another major part of the financial system is payment networks. Every day, trillions of dollars move through payment systems across the world. These systems allow individuals, businesses, and governments to transfer money quickly and securely. Credit cards, online payments, bank transfers, and mobile payment apps are all built on these networks. Without reliable payment systems, modern commerce would slow dramatically. Imagine a world where every transaction required physical cash. Digital payments have transformed the speed and scale of economic activity. Another key concept within the financial system is risk management. Economic activity always involves uncertainty. Businesses may fail, markets may fluctuate. Unexpected events can disrupt financial plans. The financial system helps manage these risks. One way this happens is through insurance. Insurance allows individuals and companies to transfer financial risk. For example, a homeowner might pay an insurance company a small fee each month. In return, the insurance company agrees to cover major losses if something unexpected happens. This spreads risk across many people rather than concentrating it on a single individual. Another risk management tool is diversification. Diversification means spreading investments across different assets to reduce the impact of any single loss. For example, instead of investing all money into one company, investors may invest in many companies across different industries. This approach reduces overall risk. Financial markets also create complex instruments known as derivatives. Derivatives are contracts whose value depends on another asset. While these instruments can help manage risk, they can also increase complexity and financial instability if used improperly. Throughout history, financial systems have occasionally experienced crises. These crises often occur when risk builds up unnoticed within the system. For example, excessive borrowing can create financial bubbles. When these bubbles burst, asset prices fall dramatically. Banks may struggle to repay loans. Investors may lose confidence. Economic activity can slow sharply. One of the most famous examples is the global financial crisis of 2008. During that period, large amounts of risky loans were packaged into financial products and sold across global markets. When housing prices fell, many borrowers could not repay their loans. This triggered a chain reaction throughout the financial system. Banks faced massive losses, credit markets froze, and the global economy entered a severe recession. The crisis revealed how interconnected the financial system had become. Events in one sector could quickly spread across the entire global economy. Since then, regulators have introduced new rules designed to make the system more resilient. Banks are now required to hold more capital. Financial institutions face stricter oversight. And stress tests are used to evaluate how banks might perform during economic downturns. But the financial system continues to evolve. Technology is transforming finance at an extraordinary pace. Digital banking, financial technology companies, and cryptocurrencies are changing how money moves. Fintech companies are building new payment systems. Automated investment platforms are making financial markets more accessible. Blockchain technology is introducing new ways to record transactions. Some experts believe these innovations may reshape the financial system in the coming decades. But despite these technological changes, the core purpose of the financial system remains the same: to move money efficiently, to connect savers with investors, to manage risk, and to support economic growth. Understanding this system gives individuals a powerful advantage. Because once you understand how money flows, you can make better financial decisions. You can understand why interest rates affect mortgages and investments, why stock markets respond to economic news, and why financial stability is so important for societies around the world. The financial system may appear complex, but at its heart, it is simply a network designed to keep money moving. Money moves from savers to borrowers, from investors to businesses, from consumers to producers, and from governments to public projects. Every time someone deposits money in a bank, invests in a company, or makes a digital payment, They participate in this global system. It is one of the most important infrastructures of modern civilization, invisible to many, but shaping the economic opportunities of billions of people. And the more you understand it, the more clearly you can see how the world of money truly works. Thanks for watching. Please like and subscribe for more informative content.